Two people invest the exact same amount of money, same year, same starting point, and 30 years later, one of those jars holds nearly double the wealth of the other. The two investors faced the same market conditions and the same 30-year timeline, yet they ended up with wildly different results. Understanding that gap requires looking past the performance of the market and focusing on the specific mechanics of the investment vehicles they chose. Many people attempt to bridge that gap by buying an individual stock, the most direct way to seek rapid growth in the market. When you buy a single stock, you own a tiny slice of one company. Your entire return is tied strictly to that specific business succeeding or failing in isolation. Financial headlines often fixate on the handful of stocks that shot up 500% in a year. These extreme success stories dominate our memory of how the market works. But the market also contains a silent graveyard of companies that no one discusses. These are the businesses that slide toward zero, eventually wiping out the people who held them until the end. Without a safety net to catch the fall, placing all your capital into one company leaves your financial future entirely vulnerable to the mistakes of a single board of directors. The mathematical countermeasure to that concentration risk is an exchange-traded fund, or ETF. Instead of betting on one business, an ETF allows you to buy a single basket containing slices of hundreds or even thousands of different companies. This structure immediately spreads out your risk across the economy. The S&P 500 is the most recognized example of this strategy, tracking a collection of the 500 largest companies in America. This chart shows the long-term performance of that index since 1926. While individual years involve severe crashes, this broad collection of companies has averaged roughly a 10% annual return over the long run. Capturing that collective performance usually costs less than 0.5% a year in management fees. By holding the entire market, the failure of any single company is absorbed by the growth of others, protecting the core of an investor's wealth. If the goal is to beat that 10% average, it seems logical to pay a professional to pick the best companies for you. That is the premise of actively managed mutual funds. You are essentially handing your concentration risk over to a Wall Street expert. This bar chart displays data from the SPIVA report, which tracks those experts. In a single year, 79% of these active managers underperformed the basic S&P 500 index. Over 15 years, the data is even more lopsided. The failure rate for professional managers climbs to 89.5%. Over a 20-year span, 94% of actively managed funds lose to a simple index fund. Furthermore, mutual funds often charge between 0.5% to over 1% in annual fees. For most investors, these costs compound over a lifetime into tens of thousands of dollars in lost growth. The statistical difficulty of picking single stock winners, even for full-time analysts, suggests that mutual funds often fail to solve the problem of concentration risk. Using this data, we can reevaluate the actual roles individual stocks, ETFs, and mutual funds should play in your financial plan. Because 94% of active funds lose to the index over the long term, a mutual fund must provide a very specific data-backed justification before it earns a place in a modern portfolio. Individual stocks are best viewed as a high-risk, speculative slice of a portfolio, rather than the foundation of a retirement plan. As this allocation shows, the broadly diversified, low-cost ETF serves as the steady core for a strategy based on historical market performance. Building wealth over decades is largely a matter of managing risk through dispersion. How is your current portfolio allocated between these three? Let us know in the comments and stay tuned for our next look at bonds and real estate.